Hey everybody, Dave Puss from JKP Holdings. Welcome back for another Real Estate Note Show. Alongside me, as always, Nathan Turner. How are you?
Oh, doing well. Better than I was
Oh,
this week.
it's been a rough 2 weeks, I guess. We had Note Expo. I got back from that, and then
Yeah.
uh, I got we went to a Tony Robbins event, and I got home from that, and then my body just crashed.
Yeah.
So I was in bed for a few days, but glad to connect for a few minutes, man, before we bring our guest on. And for those who don't know us, I run JKP Holdings and Nathan run Earnest Investing. We've been both note buyers for 15 plus years. We've created notes, we've bought notes, we've done everything in that whole world. Spoke nationwide conferences, all that good stuff. And we just bring content to you guys. As we learn, you guys learn alongside of us. This will be recorded, it could be on YouTube, our podcast, and everything else. But with that said, tell me about what you're doing lately, Nathan.
I am doing a few things. Looking at buying a couple more new notes. I'm actually selling a couple as well, if anybody's interested. I got actually one looks like it's going to go to First National. I got another one though
Nice.
up for sale if anyone's interested. It's just a little guy out in
Nice.
St. Louis, Missouri. But yeah, selling some stuff, rebuying some other notes, and working on some funding for a different project that I'm doing that looks really promising. We'll
Awesome.
talk offline about that. It's interesting. But yeah, it's going to set up 2025 to be a very interesting year.
Awesome.
It's going to be really
With that said, Nathan, what would you get when we got back from Note Expo? What was your next steps? What'd you do after getting back from Note Expo?
follow up, follow up, follow up, follow up. And I see this happen all the time. And you and I have talked about this, where you go to a conference, you meet some new people. You've collected information, whether it's business cards or their contact information or whatever. And then all too often, people don't do anything with that information. And you've just had this great introduction. You've had this great, initial meeting with somebody, and you're excited to go do something, and then just blah, and nothing happens.
Yeah.
Um, and that is such a shame. I've got some new funding partners coming out of Node Expo. I've got some people coming to DME from Node Expo. Um,
Sure.
I mean, there's lots of great stuff. That's why we go to these conferences. It's not just for the weekend, it's for the weekend plus everything that comes after the connections that you made at the conference. So follow up, follow up,
Interesting.
follow up. Send out the emails, make those phone calls, whatever you got
Yeah.
to do.
Absolutely. I think people lose that. I'm going to tell you right now, I'm going to call it everybody who met me at Node Expo. I have not got one email at all from anyone from Node Expo. I'm
Yeah.
sure you all got emails from me, right? It's something when we first do when we go to conferences. So if you've never been to a conference, I'm going to tell you to stand out is follow up with an email for everybody you've met. Hey, it was
Yep.
good talking to you. And Nathan and I's biggest trick, it's not our trick, but we use it all the time. Business cards, physical business cards. Bring them
Hmm.
and write on them. And just write on them what you guys talked about, right? And figure that kind of stuff out.
Yeah.
So,
So
so yeah,
we real quick, we talked about that while we were there, because a lot of people are not carrying business cards anymore. So we talked about it a little bit, but what's your strategy now? Like if somebody says, "Oh, I don't have a card, here's my contact information." I mean, if it goes into my contacts, I will never see that again. I've already got hundreds of contacts. I won't remember that I put you in there from that conference. I won't remember when
yeah.
so what's your strategy? How do you deal with that?
I think for me is I I I try to take a quick note inside that contact card and tag them,
Hmm.
and write down a little bit about what that is so that I can get a better understanding of it when I go back to it. But it's really hard when people share a contact. It is literally impossible for me to
Yeah.
do.
Yeah.
It
I'm
doesn't
I'm
work.
never going to remember. We meet dozens of people at a conference. I'm not going to remember that one that I put into my contacts. So with you. I'm still a fan of business cards. I think there's a lot of value in that. Same, I make notes on that card. This is who that is. This is what we talked about. Barring that, if I don't have people, just the last couple of conferences I've been to, I get out. I use Google. So on my phone, there's the Google Keep. It's just your like to take notes,
Sure.
and I get that out. So I'll write down the person's name and a little bit about what we talked about. That's where I keep everything. And then when I get home, right beside my calendar app, I can pull up the Keep app, and it becomes part of my calendar. So I can integrate it right there into my calendar. Um, I can turn it into a checklist. So once I've contacted that person, I can just check it off. It's very, very handy, but there's got to be something else, because if it goes into the contacts, it's lost forever.
Yeah, absolutely. So for those who've been to conferences and you haven't done this stuff, start doing it. If you haven't been to conferences, I would definitely encourage you guys to attend. With that said, being a note buyer for 15 years, we've seen a huge change in the industry. Things just seem to change constantly and you have to adjust with it.
Mhm.
Um, but we've seen a lot of stuff over the 15 years of buying notes, from all we did was, short sales, to buying bank notes, buying non-performers, then
Yeah.
buying and then reperforming it and foreclosing on it, REO sales, things like that. And then we turned around and said, okay, what's next? And we realized that we couldn't buy notes that were typical notes in the world of um, good yield, good returns, and things like that, which I completely understand, right? So when we
Changes in the
do,
market.
yeah. So when we do that, it makes us adjust. And when we adjust, you have to learn.
Yeah.
And for me, I we knew where we had to go,
Yeah.
right? We knew we had to adjust to understand the seller finance world, who they are, what they do, how they do it, and
Yeah.
what makes them good or not good. The
Hmm.
new due diligence we learned, right? Again, I apologize. My voice is cracky from being sick for the last couple of days, and so is Nathan. We're getting just coming over it, but we're energized because this call today, we're going to have Dan talk about, it was one of the first things we had to learn in regards to the owner finance world. What would you say the biggest difference was when you bought a note from a bank? You didn't worry about underwriting?
Yeah, totally. Because when we both got started, it was all about non-performers. So I did some note creation before that, but the bulk of both our careers has just been non-performing notes. So with that, firstly, non-performing note, my interest in the borrower on the due diligence side is minimal. I pretty much didn't care who the borrower was,
Yep.
or what their background was or anything like that. There was a little bit of due diligence that went into that, but hardly. The bulk of it was on the property and just checking it out. So yeah, underwriting the borrower and figuring out who they are, and their ability to repay and all those kinds of things, that didn't I mean, it didn't really play into a lot of what we were doing for a long time. So that's been a big shift, is trying to figure out the borrower and how we can work with them, and making sure that we can underwrite them properly and know, with some accuracy, what the pay history has been, and therefore the pay future, if you will, what that's going to look like.
Sure, sure. So I think that is the key here, right? For those who are creating notes and those people who are looking to sell or finance, underwriting is the biggest key that you may not know about. Um, and why is it a big deal? The reason it's a big deal is if you have to foreclose, or when you have to foreclose,
Hmm.
you got to do it in a spot where the borrower doesn't look like you're being taken advantage of them.
Yeah.
And that's what underwriting does. It
Yeah.
proves the ability to repay. So without further ado, let's bring on our buddy, Mr. Dan Deppen. How are you, my man?
I'm doing good. Good to see you guys again.
Yeah, absolutely.
Yeah. I got to hang out at the conference a little bit at Node Expo. It's good to see
Yep.
you.
Yeah. So Dan, can you share a little bit about your past, save our voice a little bit? How'd you get involved with notes? How did you get involved with now taking over Call the Underwriter? How those two things happen?
Yeah, sure. So I discovered notes about 8 years ago, and I found it originally when I was looking to diversify my investments outside of stocks. So when I was 19, I started buying stocks, and I was always like into that, and I had traded those throughout the dot-com boom and bust and the financial crisis. And I didn't want to move out of stocks, but I wanted to move some of my money into real estate. And even back then, the real estate market in the Denver area where I am, the cap rates on rentals were real tough. It's kind of a challenge. And so I was looking for alternatives, and somewhere along the line, I came across notes. I don't remember specifically where I first saw it, but I was attracted to that because I had my dad, and my grandfather worked in the loan business, not specifically this, what they did was different, but I had kind of grown up around loans. And then when I was doing my MBA, I took a elective in fixed income, which is different than this, but it's all bond analysis. It has a lot of similarities.
Hmm.
And that was one of my favorite courses. And so that kind of drew me into it. And then I stuck around because I like that it's a niche market that not many people participate in, right? So the size of the mortgage market and the seller finance market is vast, but then the number of individuals like us running around doing this is really tiny. So it's kind of nice versus other forms of investing where you're competing with everybody and their mom for the same deal. So
Yeah, it's amazing. I explain to people that there's as many note buyers nationwide, and they're probably a quarter of the real estate investors in New Jersey. The fact that it's so small, it is great. It's an amazing factor for us to understand that it works because it's such a small niche market. And if you understand it, you can take advantage of it tremendously.
yeah, and I mean the reason it's small is information is hard to get. There's some extra moving parts that you have behind beyond other forms of real estate investing. Not that it's that hard, but there's like some extra hurdles that tend to stop some people. And then like getting the information and how to do it has historically been fairly opaque and hard to come by. So that's kind of kept it sort of small.
Yeah, I was talking to somebody
Absolutely.
just yesterday, and she was saying she's been trying to learn about and trying to buy notes for several years. And she just never really felt like she quite got it, or where to find the notes, or, how they worked. Never to a point where she was comfortable enough just jumping in on her own. And which
Mm-hmm.
is valid. That's fair. And especially if you're
Yeah.
you're somebody who's, working a full-time job and trying to do this on the side, there's a lot that goes into it. I know we all talk about it like, it's so easy and anybody can do it. And to a certain extent, yes. Um, can understate that there are things to learn, and you can't just jump into this
Yeah,
without.
and it's hard to
without
do because I spun up doing it alongside, pretty demanding W-2. And so when
yeah,
you've got that and kids and life and everything else, like, yeah, it's not
yeah,
always a straightforward thing.
right, right. It's also nice that it's a small enough group. We don't often compete with each other,
Good.
but even when we do, it's pretty friendly.
Yeah, yeah.
We're pretty, relaxed about, if Dave will be bidding on something, I'm bidding on the same one. And we've compared notes afterwards. He won it, I
Yep.
won it. And then we'll say, hey, so what did you bid on that? And why did you bid that? And it's
Yep.
pretty, relaxed
Yeah.
competition. It's pretty nice.
Mhm.
So Dan, how did you shift gears from being the note buyer focus to becoming an underwriter?
Yeah. So, well, I mean, I still
So
buy
while we're
notes.
doing that, before we do
Yeah.
that real quick, for those in the chat, if you have used Call the Underwriter, just put in the chat and let us know you have used them. Go ahead, Dan.
Yeah.
Sorry.
Oh no, that's all right. Yeah. So I mean, I still buy notes and I'll continue to do that. But I got interested in the underwriting piece because if you look at the seller finance market, for one, it's very large, right? So if you look at the numbers that Fred and Tracy Rui have put out, it's at least 90,000 transactions a year. It's probably more because probably those numbers probably don't capture everything.
Mhm.
Um, and there's not really an easy way to do it necessarily. So, the seller finance market, as big as it is, it would be bigger if people even knew it was an option. Like there's a lot of people that don't even know it's an option.
Yeah.
And then there's like another set of people that they're like, well, I know it's an option, but I don't know how to do it, or it's not that easy. So you've got this large market that could grow if people knew how to do it. The traditional mortgage market doesn't touch it, right? Like it's funny. I just talked to a guy this morning from what I would call like the traditional mortgage world, and like all of this stuff like just does not compute for them, right? And so if you look at the way you do it now, I would guess that the majority of the people are still doing it what I call like Wild West style, which is just let it rip like it's 1980, and you're in Houston and
Mhm.
whatever. But then if you want to do keep up with all the latest compliance rules, and we can talk about that. You can go get an RMLO, but depending on the state you're in, they might be hard to find. It's probably a one-man shop, right? And so it's just not that easy. So I got interested in underwriting because I just saw the opportunity to broaden that out and make it a lot easier and more accessible to people. So actually, prior to buying Call the Underwriter, I had spent several months, I was working on actually spinning up a competitor. And then I found out that Max was interested in selling. So I was excited because that saved me a lot of trouble
Yeah.
Yeah.
by doing that. But I was already pretty deep down the rabbit hole before that, and just teasing through like all the rules and the licensing and different things. And it's another thing we can talk about. It's
So
it,
before you get too
yeah.
far with that, use a term that maybe people may not know. RMLO. What is it? What's it for? And is Call the Underwriter an RMLO?
Yeah, so that's a residential mortgage loan originator. So that's somebody who originates loans on owner occupied properties, right? So a lot of the compliance rules we talk about, like there's a big difference between creating a loan for somebody that it's going to be the residence they live in. And then if they don't pay and get foreclosed on, they're going to be out of their home, versus say like an investor loan, like a loan that somebody's going to have on a rental property, or a hard money loan on a fix and flip or something like that. So what Call the Underwriter does in the Call the Underwriter transactions, the seller slash lender is the originator. And so we act as an agent for that originator, and we help them through the compliance piece, right? So the CFPB allows you to originate up to 3 loans a year without a license. Beyond that, they consider you actually is word like habitual loan originator, but you still have to validate that the borrower has the ability to repay the loan, that you're sending out loan estimates and closing disclosures on the appropriate timeline, so the consumer has the ability to review all the documents beforehand. And so what we help originators with is the all of that consumer protection
Gotcha.
piece. And what they're getting out of that are 2 main things. One of them is, if you're originating a loan, well, you want to make sure you have a good borrower. So if you're going to hold the loan, like I want to make sure I have a good borrower that they have the ability to pay. I'm not going to have to wheel around and foreclose. I want to be able to rely on that cash flow. And then even if I plan on selling the loan, or I sell the loan at a future date, I've now got this whole package that I can give to the buyer. Cause like you guys were just commenting on earlier, right? When you're buying seller finance paper, you kind of want to know, has this been underwritten? Is this compliant? Like, is this going to cause me an issue down the road? And then the big one on the compliance piece, the nightmare scenario you need to avoid is you create a new note, the borrower defaults, maybe, early on, especially with no significant change. They didn't, have a medical issue or a job loss or something like that. So they default, you start foreclosure, and the borrower shows up in court and goes, hey, I never had the ability to pay this. I didn't know what I was doing. Dave here was a predatory lender. He took advantage of me.
Yeah.
And then the judge says, oh, well, did you validate they have the ability to repay? No. Did you send them all the disclosures? No. You could get into dark territory, right? But if you've got that underwriting package, you go, no, we followed all the rules. We did all the stuff. Here's everything we had. Well, then, then you're going to be able to foreclose on that
And
loan.
just to get clarity, right? This is number 3 is floating around like crazy. Can you clarify what the 3 a year is referring to?
Yeah. So as an individual or an entity, you can originate 3 seller finance loans per year without having to get licensed.
But
If
do you have to do the underwriting as well?
well, yeah, you still need to do the underwriting. Yeah. Which, I mean, if you're doing a one-off, right? I mean, yeah, you could go figure out the underwriting, but I can tell you it takes a little bit to figure out, to make sure, right? Like all these laws are not always as clear as you would like. That's why it took me like months to get these figured out. And I've talked to a number of attorneys, and it's funny, like I've had scenarios where I've talked to two different attorneys that would give me two different opinions on how to do something. And I had I had a fantastic long conversation with a gentleman who actually helped create a lot of the state specific rules here in Colorado. And as I was going through everything with him, because I was asking him too, like, yeah, is it okay to act as an agent right on behalf of the seller? And he said, yeah, no problem. And in the midst of the conversations, at one point I told him, like, yeah, I want to make sure whatever we do, we're not operating in any gray zones, right? It's all black and white. And he laughed at me and he's like, oh yeah, he's like, I don't care I don't care how mainstream or vanilla an origination you're doing. He's like, there will just be gray areas. It's the way the laws are written. So he's like, if you're not okay with that, like take your ball and go home. Like, it's just kind of the way it is. So that's why when, especially if you're doing a one-off deal or even, a handful of them, it's really challenging to tease through and validate, like, okay, what exactly am I supposed to do here?
Yeah.
Sure. So what would you say the biggest factor to prove the ability to repay is? We've talked to many people, and some people say a checkbook and 30 grand in the bank is proof enough.
No, I mean, it's not just one thing. I mean, if you had to like really distill it down, it's validating that the borrower has enough income to pay the loan. So like, what's their debt to income ratio? And then what does their credit look like? So, if they've got the income to pay the loan, they should be good, provided they're not, larded up with other debts. I've seen some wild credit reports, now that I've been pulling these, right? I mean, so, I've seen some where the borrower, like I had one just yesterday where I told the lender, I'm like, this borrower doesn't make enough to pay this. Like, even if they have no other debts and everything's good, it's like they can't afford this. And then you see other borrowers where they have plenty of income, but they have literally like 7 or 8 accounts that are in collections and old accounts where the lenders have given up and, just charged them off. And it's like, so I kind of in my head, like the law talks about, Dodd Frank talks about the ability to repay. In my mind, there's the ability to repay, and then there's like the willingness to repay.
The likelihood.
And you actually, in one of the elements is their credit, right? You do have to consider that. Now, one all too common thing that I don't think is a great idea is to say, okay, as long as I get a big down payment, I got this big down payment. And so even if the borrower defaults, I can just foreclose, or, maybe I did a land contract and I think that's going to be easier. And I'll just rinse and repeat. Like, attorney generals.
What's wrong with that? Take my money, take down payments over and over again, take 20%.
Yeah, look up
foreclose, take it back.
Was it I think it was it Colony Ridge?
Okay.
Outside of Houston. I think there was a company that the Texas Attorney General just went after. They had a 12% foreclosure rate. And so right now in the country, I forget what the publication said. I think the foreclosure rate is like 0.2 or 0.3 or something. But basically, like, they had a foreclosure rate that was like 50x.
Wow.
The standard foreclosure rate.
Yeah.
And they went after him. And I understand what people are thinking when they say, oh, I'll just get a big down payment and I'll be covered. But, the reality is borrowers can fight foreclosures. And if you didn't follow the rules and they get an attorney, like, they could really fight you. They can file bankruptcy and drag it out. And God knows what shape the property will be in when you get it back. Like you guys, I've done a lot of non-performers and I've had some horror shows that you get back. So like, even if you can even if it is a quote unquote, like, non-judicial foreclosure or a forfeiture on a land contract, it's not necessarily any picnic. So I don't know that it's really like in anybody's best interest to do that. And it's flat out like considered predatory, in the eyes of attorney generals. So
it just makes everybody's life that much more difficult.
Yeah, I don't think it's in anybody's interest.
Yeah. How do you verify income? because that's one that comes up often is, you know, we've got to make sure that we're making sure they have the ability to repay. What about somebody who has, what if they're like a waitress or something like that and they get paid in tips? Like, what counts, what doesn't count? How do you verify that?
Yeah. So if they're a W-2 employee,
Mm-hmm.
you're usually looking at the two most recent pay stubs and a W-2, maybe tax returns.
Okay.
If they're self-employed, you're generally looking at bank statements or tax returns. Tax returns tend to understate because you've got deductions
Yeah.
in there. So there's some different ways to do it. Where people get kind of hosed, like there are some people who do everything in cash and it's kind of like under the table or it's tips that are and
Right.
that's tough. Like if it's like cash income or stuff you're not paying taxes on, then you can't really document that, you know,
Yeah.
and that's tough. So like you as the lender, you wouldn't be able to say, hey, I've documented their ability to repay. So that's one of the downsides of earning money that way.
So we had a question from Candace on Facebook. Can you clarify if the 3 per year limit is only for owner occupied buyers?
Yeah, my understanding is it's owner occupied. So if it's not, like, let's say you're making a loan to somebody and they're going to have it as a rental, different set of rules. All the Dodd Frank stuff doesn't apply. Where it gets a little squishy or gray is if you're talking about like land. Or what if it's land they could build on it, or it's land they plan on eventually doing something. That's one area where I've heard differing opinions on. Although the other week, actually before Nerd Expo, I was talking to Eddie Speed, and he was saying, yeah, like you need to follow the rules on those if they plan to occupy. And I trust his opinion a lot. But there are some cases where it's a little bit unclear. But I think even if it's an investor, because actually we underwrite a lot of investor loans,
Mm-hmm.
I think it still makes sense to understand, like even if like say it's a rental, like you can take an income based approach and you can go, okay, you know, this is going to produce enough rental income to pay the loan. I think it still makes sense to screen the borrower because you're like, is this the kind of guy that pays his bills, or are they going to rent skim me, you know,
Yeah.
on there as well? Or I kind of like the belt and suspenders approach. Okay, this person's going to rent it, but if it goes sideways on them and they've got it vacant, they've got enough income that they can still pay me either way. And it's nice to have, because if you go to turn around and sell the loan, now you can make it really easy for your buyer. You're like, here's all the info on this, here's all the homework we did.
Yeah.
You know, just go. One of the things that always surprises me in the industry is that I think whether you're a buyer or a seller of a note, it behooves you to make it as easy as possible for your counterparty. Don't just give them like half-baked info and go, okay, go figure it out, buyer beware. Like, just do it all for them and say, here you go, and make it like super easy if you want to do a transaction, you know?
And I think people in the last 5 years haven't cared about the ability to pay because loans are performing, things are working out real well. It's when it goes bad is when these things are hugely important. Go in front of a judge, tell him you never did ability to pay, and you want him to give you a judgment that is to grant you the money that's owed to you. Any borrower will play the fiddle and will get out of it if you don't have it. There's so many reasons to get for a borrower to get out. Don't give him another one.
Yeah.
Right.
Exactly. Yeah.
So when you guys are getting this done, you know, could someone present something to you and say, listen, I'm looking to do a modification or any kind of term like that. Could you provide to a lender what the top dollar per month that person can afford is? Can we provide you documentation and go, hey, we're looking to do this. I want to see if it's, you know, 400 a month or 500 a month. Can you determine what the top dollar per month that person can afford?
Yeah, you could back into that. I haven't actually done one specifically like that yet, but you could take the application and the income information from the borrower, you know, and like look at their total monthly income and then say, okay, I'm going to be comfortable with a debt to income ratio of X, and then back in to what they would be able to afford. I wouldn't necessarily want to just take it to the max, Unless maybe you were talking about like a non-performer where it's like, okay, we're gonna do a trial payment plan and they're gonna like catch up for a little bit and then it's gonna drop down.
Gotcha.
But yeah, you could definitely, kind of back into what somebody could pay. And that's a
We're
good thing.
doing, but we're
Yeah.
doing that right now. We're looking with a borrower that owes a bunch of money to us, and we're saying, listen, maybe we make it a 12%, but maybe we make it a 20 year, or we do a 25 year, reduce that term to make it more attractive to us
Mm-hmm.
versus make it a 30 year. If they're able to afford it, let's make it happen. Right. I think for me, that makes sense. Um, what's the rule of thumb for DTI, debt to income, in your world, in the creation side?
So one of the really interesting things about the Dodd Frank rules is they don't give you hard numbers.
Yeah.
This is one of those gray zones, right? So what you're supposed to do, and this is what the guy that created the Colorado rules told me, as a lender, you create your set of standards, you stick to those consistently and you document it. And if you start to see a high foreclosure rate, you adjust them. But that's kind of how it goes. So a lot of times we use the some of the standards from the government programs. And so a lot of times we'll use 57% debt to income, which to me as a lender is pretty high.
Yeah.
Like,
Yeah.
and if I was like buying my own residence, I wouldn't feel comfortable going
Yeah.
to 57%. Like a lot of people want to be down in the 42, 43 range or
Mhm.
lower. I mean, a lot of it's what, you're comfortable as the lender. One of the things I've got on my list of things to do. So historically, Call the Underwriters giving people kind of like a thumbs up, thumbs down. Is this okay? This is not okay. But
Mhm.
I'm going to start to, at some point next year, I'll start to give them more of a chart where they can see these parameters, like where exactly does the debt to income stand? Where's the credit? All that information is in the underwriting package today, but I was going to make it a little more clear. Like, yeah, you're green, and then here's where you fall on the range of parameters.
Well, that's cool. Then you can
Yeah,
start to get creative and say, okay, well, what if we adjusted this or we adjusted that? And you can kind of work out some of the parameters and see what's going to help make the
yeah,
deal happen. That's cool.
exactly. And one of the things people need to realize too, and the other thing I'll call out that's like important when you're finding a borrower is you like, so let's say you go out, you find a borrower, they get a contract in place, we start the underwriting, and then you find out what you've got later, right? And so it really behooves lenders to have a conversation with the borrower up front. And I've got like a little cheat sheet on the Call the Underwriter website that I condensed to get an idea that where you're going to land. Because what I've seen happen a number of times already, just in the last couple of months, is somebody goes out, they find a borrower, they agree to terms, they put a purchase contract in place, start doing the underwriting. It takes a little while to get the borrower's info. You get through it and you get all the way to the end and you're like, oh, this has some problems, or, oh, this is not great
Yeah.
by a little bit. And, then people are like, oh, do I start over with a new borrower? And
Mm,
sometimes people go, we'll just kind of roll with it, which is not
Yeah.
great. So I've also been noodling on how to make it easier for people up front to kind of vet that stuff. So you don't get into this like ugly choice
Yeah.
downstream of taking a non-compliant borrower or, starting over. Cause that's what called the underwriter, right? Like we do the underwriting piece for the seller. I can't stop them. People, they're the seller.
of
They're gonna,
course.
I can make recommendations till I'm blue in the face, but people are going to
Yeah.
do what they're going to do. So I'm trying to think about how I can prevent people from getting painted into that corner.
Yeah.
So two things I wanted to double back on what you said is that you're just making recommendations. A lender can turn around and go, I'm creating a loan anyway, right?
Mm-hmm.
You don't have the authority to stop it from doing it. And B, is there some paperwork you provide from a note buyer point of view saying, oh, you originated, all you called the underwriter to a bill your pay. Is there a bill your pay certificate?
Yeah, there's something we give them now that I'm going to be changing. One of the things a lot of the buyers want, though, that we also provide is the loan estimate and the closing disclosure.
Mm.
So that shows that you followed the other consumer protection rules and disclosed everything properly on the timeline. So like if you're selling the first national acceptance in particular, right? So like if they're willing to buy stuff, generally they pay top dollar. What one of the things they're really looking for are those disclosures. So those are like super important to have. Like I said, because there are these gray zones, like, yeah, you can create like a certificate or a stamp, but in reality, because there aren't black and white standards, you're saying like,
Yeah.
me as the lender, this is my opinion of it, if that makes sense. Yeah. So the approach we take is you look at what some of the government programs do and say, okay, if you fall within these standards that these other programs do, well, then, you should be good.
So let's flip this around just a little bit. And I'm going to ask Dave. So why is it important to you when you're buying a note to see that it's been properly underwritten? Why do you care?
So for me, it's the fact that I don't want to be in a foreclosure position where the judge looks at it and says, you bought a note that has never been underwritten, that the borrower has not been approved the ability to make the payment, and you're asking me to get foreclosed on a house that they
Mhm.
bought, that you decided to put a loan on them, that they couldn't pay. And that deal, for me, the judge can throw out the whole situation out the window and go, you know what? You're done. And
Even
worse
if
and
you were
worse,
the
remove
originator.
the lien. What they could remove the lien and say, listen,
Yeah.
nope, that loan is free and clear. You just lost all your money.
Yeah. Even if you were not the one originating it, you bought
Yep.
it after the fact. Yep.
Yep.
Yeah,
That's
because
my
the
big
judge
fear.
doesn't care. The judge cares about the consumer that's in their home. You're
Right.
the speculator that bought the loan. They're not super concerned about you.
Right.
This is all coming out of the financial debacle 07, 08, when they were giving out loans like candy and people got foreclosed on because a lot of them couldn't afford the houses. I was
Yeah.
one of them, right? Couldn't afford my first house, but I got a check and said, great, I'm buying my house.
Yeah.
And
Yep.
that's what the problem is now is you can't buy that loan and go, well, it's not my fault. It's their problem. No, every loan we buy that has a seller finance part of it, I'm asking for some kind of documentation, some kind of proof from an underwriter or an RMLO saying, yes, this person has the ability to repay.
And maybe I'll buy that note. Like the more that this kind of becomes the norm, and it is becoming more the norm, I believe, the more important it is for any note buyer. So I might create one, I sell it, and then it gets sold again and sold again. At any point in that chain, somebody's going to bring up, oh, wait a second, was this done with an RMLO? Has this been properly underwritten? And it could affect your ability to even sell the note, and
Yeah.
certainly at a reasonable price. So it can have all kinds of effects. It can be just really a disadvantage to not do the underwriting properly up front. So
So someone had
it's so important.
someone had a question. What's the paperwork called when the ability to pay has been done? What do you call a certificate?
Well, there isn't like an official one, like with the loan estimate and the closing disclosure. I call it basically like a statement on the ability to repay. It's like a summary
Okay.
of here's
And
what we did. But
and the
there's not
seller
like
should
it,
be able to have that.
but
then.
there's not like an industry standard form that the
Sure, but
government has for
it,
that. Yeah.
once you do the evaluation, they should have in their collateral a documentation
Mhm.
from you stating that you evaluated and called the underwriter determined that this borrower
Yeah.
has the ability to pay.
And there's also the 1008 transmittal file that has like a summary of the loan. And then the underwriting notes, that's where like more of the detail is underneath it that says, here's our monthly income verified this way. Here's their credit, blah, blah, blah. And that kind of stuff. The 1008 is probably the closest to like an industry standard sort of
Yeah.
form, which we generate as well.
Mhm.
So Cindy made a comment on Facebook that would FINAC the disclosures have to have a 3-day spread between the issue date of the disclosures and the date of the data of the loan. If the issued is 3 days, they view the loan as non-compliant.
Yeah. So this is, it's a little confusing the way that the rules are written. So bear with me.
What?
So first you need to send out the loan estimate. Okay. The loan estimate has to be sent out at least 7 business days before you close. Saturdays can count, not Sundays, not holidays, and the day you send it out counts.
Okay.
Borrower doesn't have to sign it. They just have to have it available to them. Okay. Then there's a closing disclosure that goes out after you finalized everything. Now, because a lot of times, like what happens with me is the lenders come back and they go, oh, well, wait a minute. because every fees that the lender charges are a little different. So like maybe the fees change. I even had people come back and like change terms. So if like the fees have increased or the terms have changed in a certain way, you may need to send out a new loan estimate, which would restart the 7-day clock. Okay. Assuming you're good to go and like the borrower's confirmed and the lender's confirmed, then you can send out the closing disclosure. The closing disclosure can't go out on the same day as the loan estimate. And the closing disclosure has to be sent out at least 3 business days before you close. So there's the 7-day clock and the 3-day clock. It's really not that hard, but it ends up getting confusing in the midst of it, especially when you have.
And this
And
is
the
for,
timing matters.
is this only for for occupied borrowers?
For owner, this only applies to owner occupied, because what I have happen a lot is somebody sends me a file, on Wednesday, and they're like, hey, can I close on Friday? It's like, well, no, not compliantly, because even if I instantly wheeled around with a loan estimate, you wouldn't be able to make the 7 business day window. Now, the other thing, oh, go ahead. Yeah.
So just real quick, so clarity, guys, when we see owner occupant, mean the fact the borrower resides in a home, also known as homestead. So if this is an investor property or a rental property kind of thing, it doesn't apply. It's only when the borrower is going to live in the home. Sorry, Dan.
If the buyer is any kind of entity, this all
Yep.
goes out the window.
Right.
Yeah.
Yep. And then the other thing that happens often with the loan estimate, you might have loan conditions. So like, let's say that the borrower, I'm trying to think of a good example, but like there are some cases, let's say their credit's kind of low, like usually we're looking for a 620 credit score and above. You can mitigate that with the verification of rent. So you could ask them to produce a letter from their landlord saying, hey, they've made their last 12 rent payments on time. Because then you're saying, okay, their credit's kind of low, but we're mitigating that by the fact that, okay, we validated that this borrower has demonstrated their ability and willingness to make housing payments. Or they could have a derogatory account, right? Like they could have a credit card account that's 60, 90 days overdue. And you could say, okay, well, you need to send in something showing that you've either brought that current or paid it off, or you've got like a payment plan in place with the lender. So a lot of the issues that cause it to be non-compliant can be cleaned up, right? And those are the conditions. So if you're sending out loan conditions, they can go out with the loan estimate. And you can also send out the closing disclosure if the conditions aren't all cleared, but you need to clear the conditions before you close on the deal. Now, what happens, so the way I've been handling it, if the loan conditions are fairly straightforward and they're going to be easy, I'll just send them out with the loan estimate. Sometimes I get them where you're like, okay, this is really nasty. Like, yeah, the borrower could technically clean this up, but even if they clean up their 10 derogatory accounts, like I wouldn't lend to them. So sometimes I'll just send the loan conditions to the lender and be like, do you want to proceed with this? Like, how do you want to handle this? And I kind of leave it up to them. And then there's some like that would just be a flat out no, like they've had a, bankruptcy, foreclosure, or if they've been 60 days late on a mortgage payment in the last year, it's like nothing you can do to mitigate
And we
that.
encourage people, make sure, I get the fact you want to sell a home. I get the fact that you have a piece of property, you want to put someone in and make payments, so maybe you can sell the note or whatever you're going to do. I'm telling you right now, spend a few extra days, even a month, and find the right buyer. We're in the spot where we're trying to put people in homes, not putting people in houses, right? We want a long-term buyer. I'm telling you, as note buyers, performing notes are boring, but they're awesome, right? If I can buy a good, solid performing note, we encourage you to do it. And me and Nathan talk about it all the time on our show. We encourage you to create 2 notes, 70, 20, 10 kind of strategy where you create that first lien 70% of the value of the property, you take your 10% down plus, and then you make the second lien the balance, the difference. And that allows you, A, to sell the note, right? If you chose to sell the first lien and have an infinity return, but also puts you in a great spot that it will also pay off whatever debt, if you have underlying debt on the property as well. And Dan, you don't care how many loans you're creating, do you?
What do you mean?
If they're going to create two loans, 80-20 or 70-30, kind of note, does that
Oh
bother you
yeah,
at
no.
all?
Oh no, not at all. No, a lot of people do that. No, I mean, and that's a pretty good strategy, right? Because then, like you were saying, depending on how somebody acquired the property, they can often architect the deal so that they own the second free and clear.
Yeah.
But then because, and like a lot of people do like an 80-10-10.
Mm-hmm.
And so now you've got more equity in the first. So like you just made your first more valuable because now the first has 80 or 70% loan to value instead of 80 or 90.
Yeah.
So yeah, that's a pretty good way to do it.
Yeah. It's an interesting field as we learn it, right? Because none of this to any of us, I'm sure, up to 2019 cared about this stuff,
Yeah.
right? We're buying bank stuff. Why is bank stuff not? They're underwritten automatically. It's part of their process.
Yeah, and I got to talk to some older people about this, and I don't know what you guys think. Maybe I'm off in the weeds, but like I've got kind of a theory that back in the day, like in the 80s and stuff, Eddie Speed and all those guys were buying mostly seller finance paper,
Yeah.
and that maybe the financial crisis where everybody was buying distressed bank debt, that was kind of the anomaly, and we're just coming back to kind of where
Mm,
things were buying
yep.
seller finance. I don't know. I could be off on that. I'm interested. I need to talk to some people who have been through all those cycles to
Yeah.
suss that out. But
Yeah, the financial crisis definitely brought a lot of us to the game. But I
Yeah.
agree with you that we're going back because bank debt is not easy to buy. I know there's been people out there promoting it. I'd like to see if they close on it. And if they do close on it, I love to see their numbers.
no, they
Uh,
won't. And I can talk about that because like if you're buying bank debt, you're competing with large institutions that have ultra low costs of capital.
Yeah.
yes.
And that's why people are always like, oh my God, how did they buy that loan at that small yield? Well, if you're borrowing at 4% and you're buying debt at 6%, it's free money. It doesn't matter that it's
Yes.
low, right? But if you need some return in your self-directed IRA or you're using outside investor money, well then yeah, of course, you're never going to be able to touch that. The common like whenever anybody like discovers the note world and they look at it, like where their brain goes instantly and it's where mine did is, okay, where would I go to buy mortgages? Oh, I would go to the bank because that's where they're created. It's just common
Yeah.
sense.
Yeah.
But the reality is that's pretty tough. And so, yeah, I think some people promote that because it's like what con artists do, right? Like they want to sell somebody a story that's already in line with kind of what they believe. So it's like an easy sell. Oh yeah, of
It makes
course I would go to
sense.
the bank. It makes sense. But the
Yeah.
reality is it's not an easy go. And that's okay
Yeah.
because there's plenty of seller finance paper moving around out there to buy and a relatively small number of us chasing it. So yeah, you don't
See,
have to worry
I
about
was one of the
do it.
smart people that went to my local branch bank, Nationwide Bank, and asked the teller, "Can I buy your notes?" And they looked at me with three eyes, right? And I
Yeah.
thought I was smart. I thought I was a question no one asked them. And I sat down with a desk person and said the same question. They said, "We have no clue what you're talking about."
Hmm.
This is 2011,
Yeah.
2012. And what you don't realize is the way it structures differently, right? You're not going to buy directly from Bank of America. It's not going to happen, right? You
I
may
even
buy
went,
some small
yeah,
regional banks, possibly,
Right.
right?
And like I
I've
said, like
heard of it. It's rare.
even if Bank of America would sell to you, you're going to be getting a really low return because you're bidding against people with ultra low cost of capital. So,
Yes.
it's
Yep.
just a kind of a losing game.
Absolutely. So
Yeah.
what Dan's sharing on this call today, guys, is that not only does this loan make it valuable for selling it, right? Because to us, it becomes either a yes or a no. Why? I can't go back in time and go back to reproving the borrower after the note's created. I can't buy and fix it. I can't do that, right? It's a yes or no. So it becomes valuable, not becoming more valuable. It becomes valuable by doing the underwriting process, right? And on the flip side, when you create this, it prevents you from being a spot that looks like a predatory lender walking in front of a judge with your attorney, or your attorney probably won't even take the case, and you're going to be in a really bad spot. So I get the
Yeah.
fact there's teachers out there to say, just do this, just do that. We're telling you from a legal point of view.
Yeah, and if you've talked, if you don't think that, if you weren't the originator, but you bought a piece of paper that had problems, talk to
Yeah.
anybody who bought a harbor land contract in Pennsylvania. Like I'm one of
Yeah.
them. That's
Yep.
a whole story for another day, but
Yep.
yeah, that was not fun.
I had that too. That phone call from the Attorney General, that was not my most favorite phone calls I've ever
I had many calls with the Attorney General, and the problem I had was I was like, they wanted me to restructure loan. I'm like, cool, whatever, fine. But then the borrower wouldn't cooperate, and so
Yeah.
it became this whole thing. Yeah, I got
Yeah.
through
Yeah.
it, but yeah, it wasn't great.
Yeah, me too. It worked out okay, but yeah, different call. We'll go over that one day.
Yeah.
So Dan, it's a pleasure always talking with you. And it's amazing what you've done. Call Under is something that we all appreciate. Max and previous owners, you taking it over. What could we see in the future? We'll call the underwriter for those who are using you currently. That may be a change moving forward.
Yeah, I mean, I think one of the changes you're going to see in the coming months is the underwriting report you're going to get is going to be a little different. It's going to be more simple, yet more detailed and usable. And there's going to be more of a focus, not just on saying, hey, is this compliant or not, but teeing you up to have a more valuable loan that you can go and sell.
Yeah.
So, and then the other
Awesome.
thing you're going to see is RMLO licensing in, a number of states through the first half of
How about
next year.
automation? You and I both love automation. How
Yeah.
about
So,
automation?
I've got my first set of standard operating procedures in place, and I'm going to be doing the second set here. And then I'm going to be hiring some loan processors to turn the crank. Cause like one of the things people have told me that they've sometimes bumped into with RMLOs, they tend to be like one man shops, right? So like if that person's busy, that person's on vacation, that person gets sick,
Right.
that can be rough. And so, whereas a lot of times these deals are fairly time critical. So I don't have it yet, but in the coming months, I'll have people like on call during business hours that can keep pushing these things and working them so that we can do more. That's the other reason, like all the origination shops tend to be pretty small because one person can only do so much. As I've learned like firsthand with this whole transition process the last couple of months, like there's only so many hours in the day. So you gotta be able to hire people to scale it out, but then you got to have the systems in place to be able to do that. So I've got a big backlog of things to do for next year.
Absolutely.
That's exciting though. Lots of
Yeah.
cool stuff coming up.
Yeah, for sure.
We did have a question there. I'm going to suggest that you, Sandra, to reach out. There's a link inside the chat on how to get a hold of Dan. I would suggest you doing that and go for more of a specific questions for that. That'd be awesome.
Mhm.
Yeah,
Dan,
and I'll go back to the questions later. I
Yep.
don't have Facebook and LinkedIn up because I didn't want to like goof up the
yeah,
call.
it's okay.
So I haven't seen the questions, but I'll go back and check those later.
Yeah. So Nathan, you want to finalize our call here?
Yeah, looking at that question. Interesting question. That'll be a good one. All right. I'll be interested to hear kind of the answer to that. Yeah. So it seems to me like you're fairly bullish on seller finance being a thing going forward. What do you see coming down the pipe here? Economy wise, housing wise, what are you seeing?
Oh gosh, like historically, my economic predictions are really bad. Seller finance is already a very large market. I
Yeah.
think it'll grow at some rate. I don't, in fact, this is another thing I had a conversation with Jeff Watson about. I don't see the scenario where it would really shrink. I think it's a question of whether it's like a slow growth rate or a high growth rate. But as far as the underwriting part, since a lot of people creating stuff are not at doing any of the stuff
Mhm.
they're supposed to be doing, like there's a big opportunity in helping people create better paper. Part of the reason they do it is they don't know.
Yeah.
So so there's plenty to do.
We're
Absolutely.
happy to help you get the word out. The
Yeah.
better the notes that are created, the more we can buy. So
And
it's
some people
Yeah.
out there may say, why are you guys helping them? And the reason is all of us can buy the loans. There's
Yeah.
plenty of loans buy, right? Like I said, in the chat, there's a link, a bit.ly link, so you can fill out the form. That will be sent to us as well as Dan, and Dan's information will be sent to you. Dan also has a great podcast too, if you want to check it out. That will also be part of that thing. But and I just realized I got a message from one of my assistants, that there is a best of notes. So make sure you vote for Dan.
Yeah.
We'll call the underwriter.
Oh, yeah, that's right.
For
Thanks.
best of
Yeah.
notes. For that, choose one of us for the podcast. It's a friendly competition, but it's awesome, right? Dan's someone we've known for many years now. A lot of respect for him. A little jealousy to be kicking butt with the old seller finance notes, but real proud that he's doing it and making headway with it. So, Dan, I appreciate you joining us on this Friday afternoon as I'm losing my voice here. And it's been a pleasure having you on and talking for a few minutes.
No, appreciate you guys having me on. I enjoyed it.
Definitely. Thank you.
Absolutely. Hang on for a few minutes. And for everyone else, we'll see you soon. Our next show is going to be in a few weeks. We're going to be talking about,
Got
oh,
what we've got on the schedule.
we have coming up on sourcing deals through lists. Scar, our panel will be joining us.
Ooh,
Hmm.
Yes. So
interesting.
sourcing notes. So hope all is well, guys. Have a great weekend. We'll talk soon.
Thanks, guys.
Yeah.
Take care.